Silver experienced a sharp decline after reaching record highs earlier this week. The metal had rallied strongly for several consecutive weeks, moving almost vertically in a short period of time. When any market rises too fast without pauses, it builds a large amount of unrealized profit for traders and investors. Once prices reach extreme levels, selling pressure naturally increases because many participants choose to lock in gains. This type of behavior is called profit-taking, and it is one of the most common causes of sudden pullbacks after strong rallies. As selling begins, prices start to slip. That initial decline often creates fear among short-term traders who entered the market near the top. These traders are usually focused on momentum rather than long-term fundamentals. When price direction changes, they exit positions quickly to avoid losses. This adds additional selling pressure. Momentum traders, who buy rising markets and sell falling markets, also reverse their positions once upward movement slows. This creates a chain reaction in which early sellers trigger more sellers, and late buyers panic out of their trades. Silver is known for exaggerated moves because it is a smaller and more volatile market compared to stocks or bonds. As a result, once price turns downward, the decline can be rapid and aggressive. Another major factor behind the drop was a shift in expectations about interest rate policy. For months, markets were positioned for lower interest rates. Lower rates weaken the US dollar and make non-yielding assets like silver and gold more attractive. When interest rates fall, investors do not lose income by holding metals because bonds and savings accounts offer less return. That environment had supported the recent silver rally. However, expectations changed following political developments related to Federal Reserve leadership. President Trump announced that Kevin Warsh is likely to become the next Federal Reserve chairman. Warsh is viewed by markets as more focused on controlling inflation rather than aggressively cutting interest rates. This caused investors to reconsider how quickly or how deeply rates might be reduced. Markets react to expectations, not just current policy. When traders believe interest rates may remain higher for longer, the US dollar strengthens. A stronger dollar puts downward pressure on silver prices. Silver is priced in dollars globally, so when the dollar rises, silver becomes more expensive for buyers using other currencies. This reduces international demand. At the same time, higher interest rate expectations make interest-bearing assets more attractive than metals. Some investors move capital from silver into bonds or cash instruments that offer yield. This reduces buying support for silver and accelerates price declines. Once silver began falling, technical trading systems amplified the move. Many large funds and computer-based trading programs use chart levels and predefined price zones to manage risk. When silver broke below key support levels, automatic stop-loss orders were triggered. These are preset sell orders designed to limit losses. When support breaks, these orders turn into market sells and push prices down further. This creates a mechanical wave of selling that has nothing to do with fundamentals and everything to do with price structure. Leverage also played a role. Many short-term traders use borrowed money to increase their exposure. When prices drop quickly, brokers demand additional capital through margin calls. If traders cannot meet those requirements, positions are forced to close. This forced selling increases downside momentum. The combination of profit-taking, stronger dollar pressure, stop-loss triggers, and margin liquidation creates what looks like a waterfall decline on price charts. This type of move does not mean silver has suddenly become a bad asset. It reflects an overheated market resetting after an extreme run. Markets rarely move in straight lines for long periods. Strong upward spikes are often followed by sharp corrections. Silver historically shows larger swings than gold because of its smaller market size and dual role as both an industrial and monetary metal. The recent rally priced silver for an environment of easy money and falling interest rates. When expectations reversed, price had to adjust quickly. This adjustment process happened in one trading session instead of over several days, making it appear more dramatic. From a market structure perspective, the decline was driven by three forces acting at the same time. Traders locking in profits, a change in interest rate outlook strengthening the dollar, and technical selling once support levels broke. Understanding these mechanics helps remove emotion from price movements. Large daily declines feel alarming, but they are a normal feature of speculative markets following extended rallies. What matters is the underlying cause, not the size of the candle on the chart. In this case, there was no sudden collapse in industrial demand or physical shortage. The move was driven by financial positioning and shifting expectations. Silver's long-term behavior has always been defined by volatility. It frequently experiences sharp rallies followed by fast pullbacks. These cycles occur because traders crowd into one side of the market and then rush to exit when conditions change. This pattern has repeated many times over decades of silver trading history. Going forward, attention will remain on Federal Reserve policy signals, the strength of the US dollar, and how silver behaves around new support levels. If the dollar continues to strengthen and interest rate cuts are delayed, pressure on silver may persist. If expectations swing back toward easier monetary policy, silver could stabilize and recover. Market direction will depend more on macroeconomic expectations than short-term headlines. The key takeaway from this move is that silver became overheated after rising too far too fast. Profit-taking was inevitable. The change in outlook for interest rates added fundamental pressure. Technical trading systems turned a normal pullback into a sharp sell-off. None of these forces are unusual in commodity markets, especially in silver. Sharp declines after record highs are part of the normal market cycle. They reset positioning, remove excess speculation, and create new price structures. Whether this move becomes a temporary correction or a longer consolidation phase will depend on future economic data and central bank signals. This event highlights how sensitive silver is to shifts in monetary expectations and currency strength. It also demonstrates how quickly modern markets react when technical levels are breached. Understanding these dynamics allows investors to interpret price action logically rather than emotionally. Silver did not fall randomly. The decline followed a predictable pattern: extreme rally, profit-taking, stronger dollar, broken support, and automated selling. This sequence explains why the move happened quickly and why it felt sudden to many observers. Market behavior after extreme runs is rarely calm. Volatility increases as positions unwind. Silver's recent movement fits well within its historical behavior and does not represent a structural breakdown of the market. It represents a rebalancing of expectations and positioning. Future price action will reveal whether buyers step back in at lower levels or whether additional selling continues as traders reassess the outlook for interest rates and currency strength. For now, the decline reflects a cooling of speculative enthusiasm rather than a collapse of long-term value. If you found this analysis useful, don't forget to like the video, subscribe to the channel for more deep, data-driven content, and turn on notifications so you don't miss what's coming next.